And this one is, actually near and dear to my heart, the topic of enforcement. The session is titled Realizing the Potential of Tax Enforcement. And I think we have a really comprehensive, well-rounded group of papers. We have Aaron Towery here today presenting on how do IRS resources affect the tax enforcement process. We also have Alessandro Modica here presenting on tax audits and tax compliance. So there's some resource allocation implications in that paper. And Alex Turk will be presenting a paper on valuing unpaid tax assessments, estimating the long-run collectability using an econometric approach. So I think what we have in this session is, almost end-to-end, looking at the resources that we put into work, but also what are we getting out of it. So I think that's a really important topic for us to discuss, especially in this environment. And I think the commissioner did a good job of mentioning that in his opening remarks. Just a little bit of background about our panelists today. Erin Towery is an assistant professor of accounting at the University of Georgia. She is definitely a repeat visitor to the IRS Research Conference, and I've grown to appreciate her work over the years. Alessandro Modica is an economist in the Italian Department of Finance in the Ministry of Economy and Finance, representing the Italian government. Alex Turk is a senior manager in the Knowledge Development and Application Division in RAS, representing the Policy and Program Impact Lab in the new RAS AA division. And discussing the papers today is Mike Udell from the District Economics Group. So without further ado, I'll go take my seat and allow everybody to enjoy the presentation. And a reminder to those folks out there online, if you have any questions, please submit them to events@urban.org. And as Eric also mentioned, if you're on Twitter, you can tag, you can use the hashtag live@urban, and it is a capital L and a capital U. Thank you.
All right, good morning. Do I need a clicker?
Mm-hmm.
All right, good morning. Thank you, Ron, for the introduction. I'm very happy to be here. I'd first like to thank Eric and Alan and the IRS and the TPC for the opportunity to present this research. This paper is joint work with Michelle Nessa, Bridget Stromberg, and Casey Schwab. And as the title suggests, in this paper, we're mainly interested in looking at the effect of IRS resources on the tax enforcement process, and we're specifically going to look at the corporate tax enforcement process. Just as a disclaimer, because we're using corporate tax data in this paper, the views expressed in this presentation don't reflect the opinions of the IRS. So just to give you kind of the big motivation for this paper is this trend in decreased IRS funding that started in about 2010, and I'm sure a lot of you have seen this graph before. But as you can see, starting in 2010, the IRS funding has dropped pretty substantially. Just to put some numbers behind this, the IRS enforcement budget has decreased by 20% since 2010. There are about 18% fewer enforcement staff. The number of individual tax audits and the number of business audits have declined substantially. And all of this is happening at a time when the IRS is actually being given additional responsibilities. Okay, so more returns are being filed. I think Commissioner Koskinen mentioned that there's 152 million individual returns being filed every year. The IRS has been tasked with administering a lot of the provisions of the Affordable Care Act. We also have the Foreign Account Tax Compliance Act, and there's other initiatives as well. And so bottom line, there's decreasing resources, but there's increased responsibilities for the IRS. And that leads to our research question, which is a pretty straightforward one, but we think a very important one. And what we want to know is, what is the effect of the level of IRS resources on the corporate tax enforcement process? And as I'm going to talk about in the next few slides, this isn't as straightforward as you might think. Okay, so the first thing I want to do is just kind of give a very brief overview of the tax enforcement process. I appreciate Nina's comment earlier in the earlier session. So we're looking at the enforcement process as what happens when the IRS audits a return, the amount of proposed deficiencies and the amount of the proposed deficiencies that the IRS ultimately collects, but we acknowledge that there's other aspects of enforcement as well. But we're focusing on kind of that latter end of the process. And so, the IRS, the first step in the audit process is that the IRS is going to select which returns to audit. Some taxpayers, some corporate taxpayers are audited on a continual basis, so they're audited every year. Other taxpayers are selected for audit based on a number of factors. And then once a taxpayer is selected for audit, a revenue agent or revenue agents is going to audit the taxpayer. And then after conducting the audit, if they think that the taxpayer has underreported their tax liability, they'll propose a deficiency. The taxpayer then, when they receive the notice of proposed deficiency, they decide whether they agree with all of the proposed deficiency, some of the proposed deficiency, or none of the proposed deficiency. And so if they're not able to come to an agreement with the revenue agent, the disputed amounts can get pushed to the IRS Office of Appeals, and then ultimately it can go into litigation. So the goal of our paper is that we want to look at the effect of IRS resources on each stage of that enforcement process. Okay, so the likelihood of being audited, the magnitude or the incidence of proposed deficiencies, and then the percentage of those deficiencies that the IRS is ultimately going to collect, the settlement amounts. And so as we mentioned in the paper, the resource allocation decisions that are made earlier on are going to affect resources available for later stages of the enforcement process. Okay, and so this figure up here is from the paper. I'm not going to go through every single one of these boxes, but these are some potential responses to reduced resources, some potential IRS responses to reduced resources. So for example, if the IRS has reduced resources, they might choose to audit fewer returns. Now, on the other hand, because as we know, because the credible threat of audit is an important element of a voluntary tax compliance system, the IRS might choose to maintain their rate of audit. Okay, and so the decisions they make with regard to which or how many returns they're going to audit is going to affect the scope of the audits that they can conduct. Okay, so if the IRS chooses to audit fewer returns, they might be able to sustain the scope and the depth of the audits that they do, choose to do. However, if the IRS maintains the rate of audit, they might have to reduce the scope and the depth of the audits, and they might have to end up targeting positions that look like they have the weakest, that are supported by the weakest facts. And then similarly, the audit selection decision and the scope and depth of the audit is going to affect the resources available to the IRS to actually be able to collect those deficiencies from the taxpayer. And so the goal here, these are just a few of the potential responses that the IRS, a few potential IRS responses. There are some other responses. As we know, the IRS has implemented several new disclosure initiatives to try to help with tax compliance and tax enforcement. They've also technology improvements in technology. So those are some other potential responses. But our main takeaway here is that the effect of IRS resources on the corporate tax enforcement process is unclear ex ante. Therefore, we state our hypotheses, our predictions in the null. So we predict that there's no association between IRS resources and the probability of audit, the incidence and the magnitude of proposed deficiencies, and the proportion of deficiencies that are ultimately collected by the IRS. To test, I'm going to talk a little bit about our research design. To test our first hypothesis, H1A, on the effect of IRS resources on the likelihood of being audited, we estimate a linear probability model where the dependent variable is equal to 1 if the IRS selects a return for audit and 0 otherwise. And our main variable of interest here is IRS resources, which we measure in two different ways. We use the IRS enforcement budget, and we also use the number of revenue agents. And we're going to scale both of those by the number of returns that are filed. And we view, if we see a positive coefficient on IRS resources, that being indicative of audit likelihood increasing in IRS resources. We include several control variables here to control for various factors that could affect the corporate tax enforcement process. And these are based on prior studies, Mills 1998, Wilson 2009, and Lasowski 2010. To test our prediction on the effect of IRS resources on the incidence and the magnitude of proposed deficiencies, we estimate to estimate the incidence of proposed deficiencies, we estimate, again, a linear probability model where the dependent variable is equal to 1 if the IRS proposes a deficiency for the return year and 0 otherwise. And then when we look at the magnitude of proposed deficiencies, we estimate an OLS regression where the dependent variable is just equal to the magnitude of the proposed deficiencies scaled by the amount of tax savings. Again, our main variable of interest is IRS resources, and we view a positive coefficient, meaning that there's the incidence of proposed deficiencies and the magnitude of proposed deficiencies are increasing in the level of IRS resources. One thing I'll note here is that because we're interested in looking at the magnitude and the incidence of proposed deficiencies conditional on being audited, we limit this analysis to the sample of firms or the sample of returns that were selected for audit. All right, then finally, when we test the effect of IRS resources on settlements, or the settlement ratio, we're going to estimate an OLS regression where the dependent variable is equal to the total amount of settlements that the IRS collects from the taxpayer divided by the total amount of proposed deficiencies. So a higher variable or a higher amount of that variable is favorable to the IRS, a lower value is more favorable to the taxpayer. Again, the main variable of interest is IRS resources, and one other thing in this model is that we're going to control for the level of the proposed deficiency because that's the denominator of our in our dependent variable. And then again, our sample here, because we're interested in the effect, the amount of deficiencies that the IRS collects from the taxpayer conditional on there being a proposed deficiency, we limit the sample to return years where there was a proposed deficiency. Just to give you a brief overview of our sample, so to construct our sample, we merge multiple databases. We start with the CompuStat data set, which is publicly traded firms, and we merge that with 3 IRS databases, the Business Return Transaction File, or the BRTF, the AIMS database, where we got the audit data, and then we also use the IRS database, which Ron is very familiar with, the IRS database, which has the settlement amounts. And so our sample is going to include tax return years from 2000 to 2010. And the reason we end the sample in 2010 is because it gives us a time period for the returns to go through the appeals and litigation process. We realize for some of the later years in our sample that still might not be enough time, but that's why we're cutting our sample off in 2010. And then our sample includes audits that were conducted between 2002 and 2014. All right, so I'm going to get right into the results. For the effect of IRS resources on the likelihood of being audited, we see here that there's a positive coefficient, and the economic magnitude here is that a 1 standard deviation decrease in IRS resources is associated with a 2.3 percentage point decrease in audit probability relative to the base probability. Okay, so when the IRS has fewer resources, they're going to audit fewer returns or corporate tax returns. We have a similar result for proposed deficiencies. Again, we see a positive coefficient, and so we interpret this as meaning that a 1 standard deviation decrease in IRS resources is associated with a 3.2 percentage point decrease in the likelihood that you're going to get a proposed deficiency relative to the base probability. All right, and then when we look at the magnitude of proposed deficiencies, again, we see a positive coefficient, and in terms of economic magnitude, we interpret this to mean that a 1 standard deviation decrease in IRS resources is going to be associated with a $497,000 decrease in the magnitude of proposed deficiencies per audited return, because again, we're looking at just the returns that were selected for audit in this test. And then finally, when we look at the proportion of settlements that are a portion of proposed deficiencies that are collected, so this is kind of found this to be an interesting result. We actually see a negative coefficient here, and so a 1 standard deviation decrease in IRS resources is associated with a $179,000 increase in settlements per return with a deficiency. Okay, and so this seems a little bit odd, but the way we interpret this is that when the IRS is faced with reduced resources, they're going to audit fewer returns, they're going to propose fewer deficiencies, but they're going to collect more of those deficiencies. And it's like we interpret that to mean, or one interpretation is that the audit teams are targeting the positions that have the weakest facts. Okay, and so they're going to be able to collect more of those deficiencies. We still see that there's going to be a net loss in collections, but that's how we interpret this result. All right, so just to give you an idea of the aggregate effect, because everybody wants to know what is the total amount that we're dealing with here. So if we just first look at what is a 1 standard deviation decrease in IRS resources over our sample period from 2002 to 2014, that's about $14.2 billion. Okay, and like I said, that's an aggregate number over our whole sample period. And so what we see is that the net effect, so a 1 standard deviation decrease in IRS resources, if we take the net effect of that decrease in proposed deficiencies, but the increase in the settlement ratio, we see that a 1 standard deviation decrease in IRS resources is associated with a $3.3 billion loss loss in collections for our sample returns from 2002 to 2014. So like I said, we're just dealing with firms that are publicly traded. These are firms that are in CompuStat. So if we extrapolate that to other large corporations, we estimate that there is a reduction in collections of 28.7 billion. Okay, so it's about a 2-to-1 return. And so one thing I want to point out here, and I can't stress enough, is that we view this as a lower bound for multiple reasons. One, this doesn't take into account that there are fewer audits being conducted, so there's going to be a loss in revenue because there are fewer audits being conducted. This does not include small businesses or individual taxpayers, and so if you add all of that in, that's probably going to increase the amount of, or it's going to magnify the loss in collections. And so we stress that we're just looking at this, this is our estimate is for large corporations, and so if you were to extend this to all other types of taxpayers, there's probably an even larger loss in collections as a result of this reduced amount of resources. All right, so just to wrap up, so we believe this is an important research question, especially in light of the recent IRS funding cuts. And so what we find is that when the IRS is faced with reduced resources, it looks like they audit fewer returns. They are less likely to propose deficiencies. When they do propose deficiencies, they are smaller proposed deficiencies, but it looks like they're collecting more of those deficiencies. And like I said, again, we see a net loss in collections, but it looks like the IRS is being forced to kind of target certain kinds of transactions. And so we believe that this research is important to the IRS. It's also important to understanding the strategic interaction between taxpayers and the tax authority. And so we view resource constraints or the level of IRS resources as being an important determinant of proposed deficiencies, the likelihood of audit, and the proportion of proposed deficiencies that the IRS ultimately collects. So, thank you. That's all I have.
Thank you. So before starting my presentation, I'd really like to thank the organizer for inviting me to participate in this very interesting conference. It's a long way from Italy, but I'm very happy to be here. And I'm going to present this paper today on tax audit and tax compliance evidence from Italy, which is still preliminary, so it would questions. Can you? So I was saying that, yes, this paper is quite preliminary, so it would really benefit if you have any comment or suggestions. This is, yes, the structure of my presentation. After briefly discussing the motivation and the related literature, I'm going to describe the data set. I have some problem with the, I don't know. So I'm going to describe the data set that we built back at the Ministry of Finance, and that include information from tax returns and information from the tax audit activity by the revenue agency. After that, I'm going to present the empirical results of the model, and in particular the indirect effect of tax audit on tax compliance, and the tax audit this tax audit effect on tax compliance disaggregated by category of tax audit. And then I'm going to present some preliminary evidence on the general deterrence effect of the audit rates on non-audited taxpayer. Economic literature normally identify two effects of tax audit. A direct effect and an indirect effect. The direct effect mainly consists of on the additional revenues and fees collected as a result of tax audit, whereas the indirect effect implies promoting voluntary compliance. And the indirect effect basically implies a behavioral change of taxpayers, and this behavioral change can take two forms. If the audited taxpayer increase their tax compliance after an audit, then this effect is called corrective effect. If instead the non-audited taxpayer increase as a result of the audit activity of the revenue agency, their tax compliance, this effect is normally known as that general deterrence effect or deterrent effect or spillover effect. There are many studies in the literature that use aggregate data and that find that the effect on tax compliance is positive, and that the indirect effect normally prevails over the direct. And then there are other studies that use individual data that find instead the contrasting result. For example, we have a paper by DeBacker and co-authors on US tax data that find that tax compliance of corporation decrease after an audit. We have instead this paper by Advani and co-authors on UK data that find that compliance of self-employed increase after a tax audit. This mainly depends on the effect of tax audit on the perceived probability by taxpayer of getting another an additional tax audit. Taxpayer can believe, for example, after an audit that rarely auditors come back, and so they can decrease their tax compliance. On the other hand, they can also think that after a tax audit they could revise their probability of getting an audit up, increasing therefore the tax compliance. The tax compliance. What we do is that we look at the on a panel of Italian firms to estimate the impact of tax audit on tax compliance. We consider both different type of tax audit and different and the effect of this tax audit on different type of taxes, and we also try to extend the analysis by including the spillover effect. So to say, to check if the tax audit activity have an effect that spillovers also to non-audited taxpayer. This is, of course, particularly relevant everywhere, but it's particularly relevant in Italy, where the recent studies show that the tax evasion is quite high, and it has been estimated in about 7% of the GDP. So, of course, it's very relevant for policy advice. This is the data set we built at the Ministry of Finance, and that merged information from tax audit activity by the Revenue Agency with information from tax returns. And we decided to focus on, in particular, on small businesses, because there are many studies that show that the propensity to underreport income is quite high in this particular group of taxpayers. As we can see, we have more than 126,000 observations every year. It's a balanced panel, and we identify 4 categories of tax audit: desk audit, full and partial, and field audit, soft and deep, depending on the degree of severity of the audit. As we can see also from the table, a percentage between 7 to 9% of taxpayers are audited every year. Our dataset includes also information from this dataset called Studi di Settore, SDS, which was introduced in Italy in 1998, and it is midway between a method for audit selection and a method for normal taxation. Because basically under this program, each business is provided with an estimated level of sales, depending on the economic sector where the firms operate, and depending also on the economic inputs reported. And all the businesses, all the taxpayers that report sales below the estimated level are labeled as non-congruent, whereas all the taxpayers with value of some indicators very different from a benchmark, a computed benchmark, are labeled as non-coherent. In both cases, the probability of getting an audit dramatically increase. This is the empirical model we use. It's very standard. It's a very standard model in the panel data analysis. We use a fixed effect estimator to account for time invariant individual heterogeneity. It means that even if the audit selection process is not random, but based on some individual time invariant unobservable, our estimates are anyway consistent and unbiased. There could be some problem in our estimates if the audit selection process is based on some time variant individual characteristics, but I will come back on this later. We basically estimate that equation where the variable AIT is the audit dummy, which takes value 1 if the taxpayer I experience an audit in period in year T. These are the first results of the model. Basically, we consider 3 different types of taxes: the regional business tax, the personal income tax, and the VAT. The regional business tax is a local Italian tax on businesses. We can see from the result that following a tax audit, taxpayer seems to increase the regional business tax paid by 1.8% in the same year when they get an audit, and by a percentage by 3.1% in the subsequent year. The effect of the audit is different across taxes and looks stronger in the case of the personal income tax and in the case of the VAT. Also, the effect of the audit on the VAT seems to be less persistent, and this might be due to the fact that taxpayer can adjust their VAT payments faster. What we do here is that, as I said earlier, there could be some endogeneity issues if the audit selection process is based on some time variant individual characteristics. And this is why we run a regression-based test of endogeneity, including leads and lags of the audit variable. We find that basically future audits do not have any statistically significant explanatory power on the tax compliance, which is good for the test. It means that basically we can say that our estimates are exogenous. However, using 2 leads and 2 lags of the audit variable, these effects are confirmed in the case of the VAT and the regional business tax model, but not in the case of the personal income tax. This is why we test another assumption in the case of the personal income tax, which is the so-called parallel trend assumption. Under this assumption, basically the pre-treatment trend of the personal income tax among the 2 groups of taxpayers should be the same and should be different just after the audit takes place. And as you can see from the trend, it looks like this condition is met. And of course, we do the same analysis also for shorter pre-treatment period, finding similar result. This is the result instead by category of tax audit. As I said earlier, we consider 4 types of tax audit: desk audit, full and partial, and field audit, soft and field, deep. And we find that the full desk audit seems to be the most effective in increasing tax compliance. And this is instead the preliminary evidence that we could find on the spillover effect. So if tax audit activity actually influence as an effect that spill over also to non-audited taxpayers. And controlling, so for individual audit dummies, we find that the audit rate by province has an important and statistically significant effect on tax compliance. Indeed, increasing the regional increasing the audit rate, the audit rate by province by 1%, the tax compliance seems to increase by a percentage between 1.1 and 1.7%. We consider also another variable, which is the ratio between the tax evasion, basically the regional business tax evasion detected by province over the total regional business tax reported. And also this variable seems to have a statistically significant effect on tax compliance. So to sum up, what we found is that tax audit seems to exert a significant and positive effect on Italian tax compliance, in particular on considering the small business sector. Of course, this effect are different across type of taxes and across categories of tax audit, both in terms of persistence and magnitude. Moreover, among the category of tax audit, we found that full desk audit seems to be the most effective in increasing compliance. And finally, we also found some preliminary evidence of the existence of a general spillover effect on non-audited taxpayers. Thank you very much.
Okay, so I did that without falling down, so that's good. Okay, so this paper has nothing to do with audits. This is actually about collecting taxes or unpaid assessments. So this is joint work with Dan Hauer and Mary Musiker in the Strategic Analysis Modeling Group in SPSA Collection, and Eric Henry in the CFO office. But I want a special thanks to Eric Miller, Ken Sue, and Stacey Arlett and Sam Group for their help on the paper too. And these are my opinions, not those of the IRS. Okay, so I'll give you just a quick overview of the presentation. We'll talk a little bit about the IRS unpaid assessments and our financial statement, valuing those unpaid assessments and how this research fits into that. Talk about our data and methodology, and then show you some results from the Form 1040 and 941 models that we estimated, and then sum up with a few conclusions. Okay, so financial statement reporting of unpaid assessments. So as of FY16, there's about $400 billion in unpaid assessments that the IRS has the authority to collect. That's from the unpaid assessments data. So because there's a 10-year collection statute, that's a mix of old and young assessments. Some of them were just made, some of them are almost 10 years old. So the CFO has, in the financial statement, has to value, report on those unpaid assessments and place a value on a portion of those. Okay, so the current process is to take a sample and do an intensive case review and come up and estimate a value based on business rules and a review of the cases. So this is very time and resource intensive, and there's also inherent accuracy risk because it's really driven by what financial class the CFO has those assets in. So if it's in the wrong bucket, that's a big problem for the audit. So the CFO has basically classifies the unpaid assessment assets into taxes receivable, compliance assessments, and write-off. So taxes receivable are those voluntarily reported assessments or compliance assessments where the taxpayers agreed, essentially. So this is what the CFO value is on this financial statement. Compliance assessments are assessments where the taxpayer has yet to agree with the assessment, and write-off are cases where they've moved the asset to write off because there's limited value or limited chance of collecting. So an unpaid assessment that starts out as a tax receivable could very well end up in write off before the statute expires. Okay, so what does the inventory look like? So you can see this is both the vast majority of the unpaid assessments are individual unpaid assessments. But if you look at the portion that is a tax receivable, which is what the CFO puts on the financial statement, is about 47% between IMF and BMF assessments are what's valued on the financial statement. Okay, so the goal of this research is to come up with a predictive model or a way to estimate that value, which doesn't rely on this resource-intensive review process. Okay, so we're going to basically rely on a statistical model to estimate the proportion of the balance of each unpaid assessment that we'll be able to collect over the remaining life of the asset. So we're going to define recovery as the collections we get from today on based on how much the taxpayer owes today. So if we have that estimate, we can then discount each asset based on that recovery rate. So if it's a $10,000 assessment, if the recovery rate's 50%, $5,000 in value. Okay, so what do recovery rates or collection rates look like? So this graph is, the left chart is the individual Form 1040, the right chart is our business Form 941 assessments. This is based on the inventory of unpaid assessments in 2005. So these assets have had the full collection statute for the most part has expired. So, and this is stratified by the age of the debt. So what you see is, the recovery rates decline as the debt ages. So older debt is less collectible, but less collectible debt gets older, right? So the top line is the average recovery rate across all the assets, and then the bottom line is the percent of the dollars that are recovered. And you also see that the individuals decline much slower than the business recovery rates. So because businesses have the ability to go out of business, individuals, they only have one way they can do that, really. So, okay, so remember, our goal is to be able to identify or score the inventory of unpaid assessments. So what we did is we got a series of repeated cross sections of the entire inventory of unpaid assessments from 2004 to 2014. So 11 years. Okay, so then we also compiled all the net payments on those unpaid assessments so that we could generate our recovery rate. So there's a bit of a data dilemma, and that's kind of why we designed this the way we did. So you'd want to use more recent data on collection because that's really relevant to current day policy and current day resources. But you'd also want some variance over time because you got business cycle effects and all these other things that are going to affect taxpayers' ability to pay. But the older data is where we've actually seen the outcome of collection. So that's kind of why we combine this all in this repeated cross-section. But that we have to control somehow for the fact, so on some of the observations, we're not going to observe all the potential payments. So we come up with a way to estimate or back out the impact of the truncated payment streams on some of the cases. Okay, so we define recovery as the total net payments from this day forward divided by the balance today. So it's at a point in time. So each point in time you can reevaluate the recovery. We don't do any discounting in terms of net present value, or present value sort of calculations, and we cap recovery rate at 100%. So taxpayers could pay 125% of what they owe because they're also paying accrued interest and penalty. Okay, so if we do and once we have that recovery rate, we can estimate the value based on that recovery rate times the balance. So we developed separate models for various different tax class, Form 1040, Form 941, 1120, et cetera. And we model all cases, not just the taxes receivable portion of unpaid assessments. Okay, so this is just mathematically what I just described in words. So, but the specification we use, so we have this variable on the 0-1 interval of recovery. We model that as a logistic function of the set of case characteristics, things like what status it's in, past payments, those sorts of things. So those parameters are going to give us the parameters for our model. But we have to control for unobserved payments. So a case has unobserved payments in our sample if at the end of the sample, so we observe cases all the way through 2016, it's still there and we haven't got to 100%. So then that's a truncated payment. So what we do is we model the probability that it's going to have truncated payments. We're not going to observe all the payments given what we know today as a function of all the variables X in X, but also annual dummies for which cross-section the data is coming from. So this is going to provide us a predicted probability we can include in our recovery model. So we include both that probability in our recovery model, and also at the end of the sample, how much time's left on the statute? How many more years do we have to collect that we haven't observed yet? Okay, so to come up with a full statute estimate, we basically back out those two variables. We set those to 0, and that gives us our full statute estimate. Okay, so we need those to estimate the model, but not to do scoring of the unpaid assessments. Okay, so what does that look like? Well, so this table is those two statistical controls for truncation. So the column on the right is the time remaining at the end of the sample. So you can see across the board, those are all negative. So the longer time available to collect, the more time left on the statute, the bigger the increase, the bump up in the recovery, it's going to happen, right? But the probability of truncated payments actually has a positive sign, so that thing is actually working in counter to that. So you think, well, that doesn't make, the first one makes sense, the other one doesn't. But the probability we don't see all the payments is also related to the probability that the collectability. So cases that are higher, more likely to be truncated, they get less of a bump, all else equal. Okay. So what does it look? So this graph is basically showing the scoring, the recovery rates for Form 1040 for each of our cross sections from 2004 all the way out to 2016. So remember, 2014 is the last data we used in estimating the model, but we score 15 and 16 as well. So the black lines are the full statute estimates, and the blue lines are the actual observed in the data. So the dashed lines are the percent of the average recovery rate, and the solid lines are the percent of the dollars recovered. So you can see these two lines start out together, but as we get more and more to current time, they start to diverge. And so what's happening is our statistical controls are bringing that up to the level, because you can see the green line that we've laid over that's the percent of the cases that are where we actually have truncated payments. And by the last year, there's 70% of the cases we haven't seen all the chances to collect Okay. So in terms of aggregate value, this chart, so we've overlaid the aggregate value and the total module balance. So the axis on the left is the estimated value, and then the axis on the right is the total module balances on those assets. So you can see again, it gives us divergence, but the full statute estimate is roughly proportional to the balance over time. But you do see that the aggregate balance in the Form 1040 assessment is growing. Okay. So just look real quickly at Form 941 results. So you see similar patterns, not exactly the same. So you see, and you can see as we get closer in time, you see this divergence between what we actually observe and what the model's estimating. But we also see a downward trend in the recovery rates. So, but remember, if you look back at the graph, those 941 assessments decay very, very quickly, so that truncation is not as severe in this model as it was in the IMF one, or the Form 1041. Okay? So, and if we look at the same chart, the chart of the aggregate value and the total module balance, we see a different trend in the total module balance. We see, if we look at our actual versus the full statute estimate, they are moving together, and then they diverge as we get towards current day. Okay? So just to dive into this Form 941 model a little further, we just want to look real closely at the taxes receivable portion, because this kind of highlights one of the benefits of using this approach. You can see, so this is just the taxes receivable portion of the Form 941 UA. So you can see in 2010 to 11, you see a big jump in recovery rate. Well, what's going on there? You also see an increase, somewhat of an increase in value. But if you look at the chart at the right, look at the aggregate module balance, there's like a $10 billion decline in what is in taxes receivable. And what happened is that tax receivable, those cases moved to write-off. But you don't see a decline in value because the model had already written them down. So just because they were in that bucket didn't really have an impact on value. So that if you extend that, that's going to have less of an impact if we actually have a case in the wrong bucket. We're still going to be valuing it, hopefully, more accurately. Okay, so the benefit of this approach is that it estimates, the data. It's data-driven, estimated from historical collection rates from a fairly long time series. Very transparent. We can go back and say, if you change this, if the case moves from this status, how much does our estimated value change? And we can value UA continuously every week if you want to, as new information comes available versus the annual sample. There's quite a bit of time lag. And also create estimates. We can now value the entire unpaid assessments inventory, not just taxes receivable. So this is going to help to address the material weakness and ensure IRS maintains its clean audit opinion. Thank you.
Well, while they're setting up, I'd like to take thanks to the IRS Research Division and TPC for inviting me to come and talk to you. Can everyone hear me? Great. So actually, I'll just start while they're fumbling around here, which is good. So when I was asked to look at these papers, I was trying to figure out, well, geez, is there a common theme here? How could I tie two papers that are about auditing and one paper that's about valuing an unpaid assessments, or what I would have called accounts receivable, but let's just call it unpaid assessments. How do you pull these things together? And so, not being in the government and being in the private sector, I hope I came up with a novel way to do it. Cue the slides. I can do it. Which way do I go? I'm going backwards, right? The other forward. Thank you. Okay. Sorry about that. So, how do you tie these things together? And so, the way I thought about it is, what if you were going to buy the IRS? Or what if you were going to buy the IRA, which is the Italian Revenue Agency? And if you think about it, they're both businesses. They both generate a lot of revenue, all right? They both have costs. And you have to figure out, if you're a buyer, and let's say right out the bat that collecting taxes is an inherently governmental thing, so this is just a thought exercise, okay? But if you were a buyer, all right, you would want to figure out what are the functions they're doing, and you would want to figure out how they're contributing to, in this case, revenues, all right? And if you were doing your due diligence, you would want to understand if they were doing something that you think you could do better. Because if you thought you could do it better as a buyer, there's a higher return on the asset base, and you might be more interested in paying for that. All right. So in that framework, all of these three papers actually kind of all fit together as analysis about valuing different functions that the IRS does. Two functions really of hundreds and hundreds, so let's be clear. But if you were going to do it, let's just start with what the basic metric is. And so for the IRS, the basic metric would be, well, how much revenue do we collect per person in the country? It's about $8,979 per person. That's per everybody, 323 million people at the end of FY 2016. The 2.9 trillion is the net revenues. That's just a data book number. So that's my starting point. And now I'm going to look at these papers and go, well, how do they contribute to that? And how do they not? And we're going to give some tables that actually aren't in either of the papers that sort of help speak to this. So that's my starting number. And the three papers can be thought of as doing due diligence on how to value this stuff. And let me quickly get to the punchline here. There are two papers about audits. One paper talks about the efficacy of audits, all right? And that is the IRA paper. What are audits useful to the revenue system? And the punchline, and probably the biggest punchline of the three papers, is that in the IRA paper, there is an enormous general deterrence effect. Now, I believe there may be some statistical issues with it, and they recognize that in the paper, but they basically got an enormous general deterrence effect, and so how enormous? Their audit rate for small businesses that would be comparable to our audit rate for small businesses, the way you would construct it, and we'll get to that in a second, is about a 1.85% audit rate, okay? And they find that if they increase that rate by 1%, they would get a general deterrence effect of a 1% increase in compliance. So in our country, we have arguably an 85% rate of compliance, the voluntary compliance level, and that would increase to 86%. That's a really, really big number, okay? So apart from some statistical issues, that is a really, really big effect. And I was a little surprised, but it's comforting since my first entry into this was in 1990, trying to estimate the general deterrence effect with aggregate data, finding some effect, but a little bit. Alan upped that ante in his 96 paper. So this paper fits in a stream where we're trying to tease out what is the general deterrence effect of auditing. I will say that the Italian paper addresses small businesses. And that brings me to the second paper. The second audit paper is about the efficiency of audits. Do you do a light touch? Do you do a lot of audits and just a little light touch and get a high agreed rate? Or do you do more intensive audits and get a higher unagreed rate? And the paper spends a lot of time trying to tease that out, but I have to say the paper has a giant bummer result. And the bummer result is there's no general deterrence effect for large corporations. Okay, so as valuing the IRS, I'm concerned about large corporate audits because I don't get a general deterrence effect. All right, that paper has a substantial amount of statistical issues that we're going to talk about. Okay, the third paper is totally different. How do you evaluate your delinquent debts? All right, and this is a great paper because it solves a problem that the IRS needed to solve. It solves the CFO's problem with the GAO audit. And so for that alone, I think the paper is a success. My comments about it are going to be about, it's such an amazing data set, what could you do that might be a little better and a little more interesting, but might take a lot more time? So one of the things that all three papers has in common is they have fabulous data sets. Back in the 1990s, we had terrible data sets. We were always teasing out these issues, the compliance effects of audits, how to value an accounts receivable inventory with really poor data. All three of these data sets have incredibly fine, focused data, which means that there's a lot more to do with the data sets. So I'm going to take the papers in reverse order. I'm going to talk about the valuing your your unpaid assessments inventory. So this is $400 billion of unpaid assessments, and remember we had a $2.9 trillion revenue system. This is all FY 2016. So if you're a $2.9 trillion business and you have a $400 billion delinquent debt, right? How does that compare to the private sector when they have bad debts? 400 billion divided by 2.9 trillion, what, maybe 14%. That's a big number, okay? But it's not the right number that you would want to compare with, say, a credit card company. And that brings me to the first comment here. This paper was done to satisfy the CFO's problem, which is generally not the economist's problem. And the big reason is, I'm going to have to walk away. The write-offs, the compliance, the individual write-offs, the individual compliance, these things don't show up in what we would call accounts receivable for the most part. okay? These are things that we would think about as currently not collectible write-offs. These are the trying to get the blood from the stone. The CFO has to value these. The stuff over here, the individual and the business receivables, 47%. That's what is actually called the accounts receivable, okay? So if we looked at it that way, the accounts receivable is half of the 400 billion or a little bit less. So now we're down to 200 billion of real delinquent debt. And on a $2.9 trillion net revenue system, you know, we're 6%, okay? So our bad debt's 6%. What's the bad debt for Visa and MasterCard when things are going well? 4%, 3.8%. And they get to choose their customers and the IRS doesn't. Well, no, that's a big deal, right? So here I am, I'm trying to figure out how does this as a business, this doesn't look all that bad, okay? Just saying there's some good news here, all right? So what do? The purpose here is to measure collection potential, all right? We all know that old debt is much harder to collect than new debt. Consistently show that with the graphs in the paper, all right? Here's where I want to change this topic a little. The analytic approach to this paper is to look at cross-sections. Take a year and look at the slice. We're going to turn that on its head and say, let's look at the panel, let's look at the time series. The time series is the common theme in all three papers, and where all three papers are challenged, statistically, is in how they're dealing with the time series nature of the data. For the most part, they're throwing away a great deal of information because these are time series economic problems, okay? So now I'm going to go to, this is my last slide on this, but it's not the periodic chart of the elements, but it's actually an important chart about how to rethink this issue. You mean 5 minutes for the whole thing? Yes. Oh, well, that's not very, okay. All right. Let me just finish with this and I'll get to that. The dark colors are what they have for data, okay? The yellow bars are actually, they have 10 years of data. They have the full collection statute for a module, all right? The dark red is they have the collection statute, but only for some later part of that module. The fuzzy red stuff, they don't see, but it happened. So in economics or econometrics, that is called censored data, okay? The very light green data at the bottom, they don't see, and it didn't happen. That is truncated data, all right? This is important because we have different statistical approaches to dealing with this. The bright green, they see. And so here's how they want to think about these data. The black boxes happen to be recessions, okay? And the 1, 2, 3, 4 just says year after recession. Instead of looking at this as cross-sections, they should look at these as panels where they have a whole bunch of taxpayers who are in collections 1 year after recession, 2 years after recession, or a whole bunch of taxpayers who are in their third year, okay? And in that, why is that important? Because in 2017 and 2018, they have a whole bunch of taxpayers in the modules in their third year, in their fifth year, in their sixth year. And what they really want to do is understand what does a 6-year module with a whole bunch of common features do in terms of collection. And when you look at the problem this way, two big things happen that they're not using that they should. First of all, you get to pull in IRS resources, which is a common theme here, all right, because we know IRS resources decline during the period. But more importantly, they get to pull in general economic data. They get to pull in the unemployment rate. They get to pull in the cost of credit. The cost of credit is a huge issue in an accounts receivable inventory. In 2006, it was much easier to pay a tax debt than it is in 2010, all right, because of the cost of credit. So all of a sudden, you got to bring in lots of economic data for all returns in their third year in collection. So here's the interesting thing. If you look at all the returns in the third year of collection and you look at the economic data, you're going to have modules in years of a recession, modules in years of an up business cycle, modules in years with big IRS staff, and modules in years with low IRS staff. And you're going to be able to improve the estimation of the value of the accounts receivable inventory because you're going to control for the economic conditions and the IRS's own conditions. So I have to stop because that was more than I wanted to say. So if I have 2 minutes, I want to get to the other two papers. Get to, okay, I'll bargain for, you say one, I'll say two. Great. All right, so the big thing here is, what happened? Okay, the big thing here, this was from the Italian paper. I want to make really one point. Their data is very, very similar to our data, okay? And so what this is, and I'm going to have to go to the screen. They had 126,000 small businesses, and they said they had audited 7%. But going to Nina's comment earlier, actually, this thing they call the desk full, that's our full field audit. That's in the language, they have their language flipped with ours. That 2,339 is 1.85%. So basically, they audited 1.85% of the small business folks. And these other categories here that sum up to 8,000, they are a variety of touches with the taxpayer, some of which are just informational, all right? So we have a lot of that kind of activity over here, all right? So in fact, the Italian, this study is remarkably useful for the US because a 1.85% audit rate on small businesses, I'll bet you I can go to the data book and find that pretty quickly. That's not an out, in fact, we may even have a higher audit rate. So what they find is, they find a really large compliance effect on a data set that's actually not all dissimilar except for one huge thing, 30 seconds. And the huge thing is they have this Studi di Settore. Studi di Settore. That's a governmental agency that gives the taxpayers pre-filing information about what their sales should be and information about how many employees and their wages should be. And that's very, very similar to a study that we did in the US, that Joe Slemrod did, the Blumenthal, Minnesota studies. Very, very similar. And so what's going on in Italy is they're doing basically the Minnesota experiment, but they're doing it full time. And they're getting a compliance kick out of this. So that's very, very interesting. And I'll have to stop there, and we'll talk about econometrics afterwards. Sorry.
I think the next step is to open it up to questions to the audience, but first I want to give the presenters an opportunity to respond back to the discussant.
I can respond to the first part of your presentation, even though you didn't get to my slides. But two things. One is when you said the bummer result about the not a deterrence effect. Now, I will say that our sample includes only returns that were filed between 2000 and 2010. So that was before the IRS budget started getting cut drastically. And so I think if we were to redo that result with returns that were filed after, we might actually see, like if the taxpayer sees that the IRS budget is decreasing substantially, that might actually reduce the deterrence effect. And so I think that's partially a function of our sample period. And the second is we are well aware of our statistical issues. I just regained access to the data, so I'm in process trying to process those things. So thank you.
So I think that's a really great point. It's an unanswered question empirically right now, whether there is a general deterrence effect for large corporations. The Italian paper, the IRA paper shows there's a pretty large compliance effect for small businesses and individuals. We know that in U.S. there is a general deterrence effect. So this is we're waiting for bated breath to see if you can find a general compliance effect to large corporations.
Stay tuned.
I just wanted to make a point on the endogeneity issues. Basically, what we do also in the case of the audit rate by province is trying to run this regression-based endogeneity test also on the audit rate by province, and the preliminary results seems good in this way. And then my question is, if, because I would like, as a next step, to try to estimate the model with using a dynamic panel analysis that also accounts really for the time series, nature of the data. And so I would like to know if, in your opinion, this could solve part of the endogeneity issues.
So I think it would go a great distance. Here's the fundamental issue all three papers have, and all three papers should try to focus a little more on it. They are panels, and they follow individuals, and this is the virtue of their data sets. They are incredibly rich individual level or firm level data sets. There is a tremendous amount of sequential behavior in all three papers. That is, you're a taxpayer, you're audited, there's a result, agreed or unagreed, there's collection. These are sequential moves. The thing that jumped off the page to me for all these papers is this looks like an ordered probit or an ordered logit with a continuous variable outcome. That's a model that's well understood, and it will help control the error structure. And the error structure is key here because it's why the audit effects are kind of weird and squirrely. They're squirrely because there's should be a whole bunch of endogeneity here. You even found it in the PIT part, the personal income tax part in the IRA study, because when they used a test to test for endogeneity of the audits, they actually found that the audits were endogenous. And so all three papers have this issue. The CFO paper, it's not a big deal, or because they're using it to solve a particular problem, but all three data sets have the issue, and so we want to see more specification of the error structure over time, and there's plenty of statistics to tease that out.
Yeah, thanks for your comments. I feel like you kind of monopolized the time on my paper, so I took one for the team, I guess. So, no, you're absolutely right. The purpose of the analysis kind of drove how we constructed the data. But we did try to control for some of those things with specific measures of ability to pay and other things that would proxy, some of those economic factors. But as you try to forecast the future, we're not going to know what those economic variables are going to be. If we try to value the assets today, we don't know what when the next business cycle is going to happen, right? So, and that's what's going to affect the payments over the rest of the life cycle. So, but no, yeah, your comments are very well taken.
No, that's right. That's a good point. But just suppose, and so the CBO has already put a recession in their forecast somewhere in the next 2 years. They do a lot of smoothing to hide it, but it's sort of buried in there. So suppose you're the CFO and you land a year in the recession, and you're now looking at, okay, what happens the year out of the recession and how do I value my inventory? That's where looking at it in this fashion really is going to pay, it's just going to refine the analysis, but it's going to allow you to include as right-hand side variables all the different kinds of programs that we don't see that you see about how to collect, how to do notices differently, all the liens and levies, all that activity they see in their data set, and they can tease out the impact of those on the stages of the collection cycle.
Thanks. So before I open it up to the audience, I actually had a couple of questions for the panelists. So Aaron, in your paper, you mentioned, kind of shifting to positions that appear weaker as a strategy. Have you given any consideration to look at just kind of the shift in the issues that are actually audited for some of the large corporate returns?
We'd love to have data on that. And I think we've talked before about you saying that there are some databases that would show us what kinds of issues are underlying the different adjustments. And so I absolutely think that'd be fascinating to look at, to see if there's a shift to certain kinds of issues that are being audited. So thank you.
Yep.
I'll touch base with you
Yeah,
later.
I have plenty more questions for you, so we'll touch base after the fact. And Alessandro, I'm just curious about, I think your paper is looking at both, kind of audit type, audit intensity across multiple tax types. So I'm just wondering, have you tried to kind of mix things up across those different parameters to kind of see what's most effective for who and what?
Yes, actually we did it. We perform a regression with all the categories of tax audit, and the most effective one is turns out to be the desk audit, which is basically when the Internal Revenue Agency really check every single figure of the taxpayer of the tax returns, and this is the most turns out to be the most effective, actually.
And a follow-up question around the spillovers. Have you given consideration to, kind of relationships between the non-audited taxpayers and the audited taxpayers? For instance, they could share the same preparer, and there may be a transmission path that is kind of going to be more effective than just the general, kind of deterrence or spillover effect.
Basically, in the regression, we control for individual audit, and then we check whether the audit rate has an additional effect on that. See, and so, but interaction between we didn't look at that part. But thank you for the suggestions.
Any questions from the audience? Got one in the back.
Hey, Ron, thanks for asking one of my questions to Aaron. Having been in LB&I during that time period, there's two other aspects of that paper I'd be curious. Number one, did you look to see whether they're temporary versus permanent adjustments? Because I would hope that with fewer dollars going forward, that would be the primary focus would be perm items. And then also, if they are better items, they should be, the agreed rate, I would think, would go up, and they would be sending less of them to appeals. And then Ron's issue also on have the issue shifted and have a better focus, and that's what's also drawing in more cash.
Thanks, Lisa. Like I said, we don't have that data right now, but we've talked about it. So I think that would be really fascinating. I think that not only that, but I think it would be helpful to the IRS and kind of examining the specific kinds of issues and seeing whether they're permanent or temporary types of adjustments. Yeah.
I think we have some over here. You guys can fight it out.
So a question this is Pete Listowski, University of Illinois. So Aaron, have you looked at, Ron had mentioned preparers to Alessandro, but have you looked at kind of paid preparers, or if they use auditor-provided tax services, and how that would shape the audit probabilities, the settlement ratios, the proposed deficiencies? And then for Alex, I was kind of wondering if you could rank the importance of how the costs differ in terms of delays in which form. So are unpaid assessments in Form 941s more costly? Are the delays more costly in collecting those than the delays in collecting assessments from the 1040 or the 1120 or the 1065? And do you think the IRS could maybe apply more resources to where delays are the most costly in terms of collection rates?
Thanks, Pete. So we do have the paid preparer, and I think, I can't remember if it's this version or the last version, but we did have paid preparer in the model, but we just didn't have that much variation just because we have so many, like the firms are large corporations, and so I think maybe over 90% of our sample had paid preparers. Now, to your paper that looks at kind of the distinguishing between if it's a Big Four preparer or if it's a preparer that is your auditor versus not your auditor, we haven't looked at that, but I think we just didn't have that much variation. We had an indicator variable in there for whether or not there was a tax preparer, but I don't think it was loading just because there wasn't that much variation.
I think you're absolutely right, and I think the IRS actually does do that. You look at the Form 941, the federal tax deposits. IRS is very proactive in terms of trying when businesses fall behind, even before the return is due, to go out there and get them back into compliance. Versus individual, you can delay, and it's probably somewhat related to the trends you saw in that total inventory.
This is Lillian Mills. I'm a professor at University of Texas at Austin, and I'm still pleasantly distracted by Dr. Udell's thought experiment of which country would you buy if you were Apple sitting on a bunch of cash. I I sense the takeaway in that thought experiment is maybe the private sector could find efficiencies in collections, but I wanted to toss the thought experiment back to you and see if that was your conclusion. And the thought that we could pick our customers, certainly the IRS tries to shift contract workers to employees when they can by way of recharacterizing the customer, but do you have other thoughts on that part of the thought experiment? Thanks.
So just, I don't want to monopolize the time, but no thoughts about the IRS picking its customers because it's a governmental activity. The idea was that all three papers are really about valuing something, all right? How do you value the corporate audit and the different ways that you do it? And so in Aaron's paper, they said, there used to be a Budweiser commercial where the commercial was about Bud Light, and the one group would say tastes great and the other would say less filling. And so there's really a contrast going on in Aaron's paper, which is, do you do more audits but be friendly and get a higher agreed rate, or do you do fewer audits and be more unfriendly, get a higher unagreed rate, but you end up with more revenue? And so that's really sort of the test that Aaron's paper was putting out there, and that's why I said it was a bummer that there's no general deterrence effect yet, but that's stay tuned. So it's really not, it's really about, if I was valuing the activity as a buyer, I'm always trying to figure out if the company I'm buying is doing something wrong and I can realize that I can do it better, because then there's value there for me that I get that they don't understand. And so that's the sort of the approach here. The same thing with the unpaid accounts inventory. You think of it as a grocery store with an inventory of food, and it goes bad over a period of time, and that's exactly what happens in the unpaid accounts inventory. And you're trying to figure out how to value what you should be doing in that inventory to move it around. And 53% of the unpaid accounts inventory is totally spoiled spinach. It's currently not collectible, and it's being written off. And so the trick is to figure out how to change that.
Hi, Eric Hutton from the IMF. I have two questions for Aaron, or comments for Aaron and Alessandro. Your paper where you're showing a 2-to-1 return per resource is an interesting result, but that's obviously not a linear effect. So I was wondering if you're looking at how that's going to decline and where you get to a point where, what was the theoretical point where you'd get to the return cost and the resource cost being equal? Obviously not an optimal size of the administration, because there's other things to take into account, the drag from tax compliance costs and all that. But that would be an interesting extension of what you're looking at there. Alessandro, there's a really interesting, but there's something that might be interesting to look at in your paper, and that is how taxpayers' assumptions of the risk model of the administration, how that affects the impacts of audit, and how closely that mirrors the actual risk model. So in some countries, the risk model for a VAT is very simple. If you ask for a refund, they'll audit you. And so there's very little compliance effect. All the people who don't want to be compliant never ask for a refund, and they never get audited, and they're getting away with murder. Anyone who needs a refund, they ask for it, and they're 100% compliant. So there you see they know the model, and they can get their way around it. So I wonder, but then there's other countries who say, no, we want a very transparent model so taxpayers know what the risks are, and when they have a better risk model than simple refund triggers an audit. So there might be something interesting to look at in there as to how transparency and how close the perception of the taxpayers to the risk model plays into both effects of audits.
Mm-hmm. Okay. So we can do it analyzing the studi di settore. That is the SDS, which is midway between the audit selection and a method for taxation. So it would be interesting to look deeper in different in this audit program. To thank you for the comment. It's very useful.
We're absolutely planning on looking at how this relation isn't necessarily linear, right? Like this is the 2-to-1, that kind of ratio is going to be different for the very largest corporate taxpayers versus ones that are maybe more middle-sized taxpayers. And so that's something my co-authors have definitely thought about, but that's a very good point. Thank you.
May I just quickly follow up with that, Aaron? So in your data, do you see CAP and pre-filing technical guidance? Do you see any indicators in the taxpayers about whether they've entered into these various information disclosure arrangements with the service?
I can see in the data right now, I can see CIC assignment. I don't have CAP participation, but I think that might be something I can get, Ron.
Yes.
Okay, all right. So, but thank you.
Any more questions from the audience?
Hi, my question was for Aaron. This concept of a standard deviation as far as the unit of measure for judging the budget difference, how did you come up with that, and what made you decide to use that as the variable?
So we were doing the standard deviations just to see, it was kind of a way for us to evaluate what is a change, that was the measure we used as a change in IRS resources. And so we've also gone from, if you're going from the first quartile of IRS resources to the third quartile of IRS resources, but we chose to put the standard deviation. But we just, it was like, this is an annual measure, so we just took, the standard deviation of IRS enforcement expenditures. So we just took, took one standard deviation of that, and then we aggregated it over our sample period from 2002 to 2014. Now, to your point, one comment that we've gotten that we're working through is getting something other than just an annual measure. We've gotten feedback that it'd be helpful to get a little bit more variation, and so we thought about maybe getting the IRS enforcement, or maybe audit hours by region or audit hours by industry. So something that would give us a little bit more variation than just an annual measure. So thank you.
We have one up front.
Hi, William Hoffman from Tax Notes. I unfortunately flunked math for athletes in college, so can you translate one standard deviation into a dollar amount so that we could say X amount of dollars less for IRS or more for IRS translates into Y amount?
Well, thank you. I read a lot of your articles, by the way. So I put this on the slide, but I know it was up there for just. But if you look at a one standard deviation decrease over our whole sample period, so this is for 2002 through 2014. So you would divide that by the number of years to get the annual measure, but it's 14.2 billion. So if you decrease the IRS budget over that time period by 14.2 billion, it's going to result in a net loss in collections when we do our extrapolation by 28.7 billion. So, does that help? Yes. Okay, great. Okay, thanks.
Any more questions? About 5 minutes between you guys and lunch.
You're done.
Okay, I think we're done. So you guys can get to lunch. There's tons of data for you. I mean, you don't even realize you can do cap stuff.
My pleasure. I got.
Cap work is kind of classified into specific NFT codes. So you can get that. Being interested in looking at it, because it's something that we're facing is that enforcement revenue is increasing right now. So I think why is because the law.
Peter is a principal in the tax practice of the National Tax Office, National Economics and Statistics Office of PricewaterhouseCoopers. He's been doing that for 25, 30 years, long time. He's one of the, before that, Peter was the chief economist at the Joint Tax Committee. Peter's one of the leading experts in corporate and international tax in this town, and we've had the pleasure of encountering him at many conferences before. But in addition to that, he's also an expert on value-added taxes and consumption taxes. And this is a very interesting year in tax reform because it's the first time a major political party or a major group has introduced a national consumption tax as part of the tax reform, a very serious part of the tax reform effort, although what's going to happen to it remains to be seen. We've often referred to it as a value-added tax with a wage deduction, but they don't like that terminology. In any event, Peter will talk about various kinds of consumption taxes and cash flow taxes and some of the enforcement issues that might create. So I'll just turn it over to Peter.
Thank you, Eric. So thanks to Eric for the kind introduction and to the IRS and the Tax Policy Center for organizing this conference and inviting me to speak. So my goal in the next 20 minutes or so is actually be as creative as Mike Udell was in thinking of the IRS as an acquisition target. So I called my talk a tale of two taxes, and as in a tale of two cities, we have a comparison today in tax reform of London and France. London and Paris, I should say. France, and probably Paris, is the place where the value-added tax was invented, I think circa about 1948, after the World War II. London, maybe more precisely Oxford, is where Michael Devereux is located, and he's one of the co-authors of the destination-based cash flow tax. That is the sort of nucleus or core of the idea behind what is called the House Republican blueprint, the Ryan Brady blueprint. And what I'd like to talk about is a comparison of the destination-based cash flow tax with the more traditional value-added tax. Both proposals are consumption taxes. Both would replace a large part of the income tax system, and both would have a lot of desirable economic effects. But my conclusion is that the more traditional VAT would be preferable to the destination-based cash flow tax. And I'm going to focus a lot on tax administration reasons, because this is a tax administration conference, but I'll say a few other things on domestic and international issues. So the representation of the destination-based cash flow tax, as I said, is the Ryan Brady blueprint. And the way that you can think about it as at a very high level is, as Eric said, a 20% subtraction method VAT combined with a wage deduction. The subtraction method of that in form looks a lot like an income tax. You subtract your domestic purchases from your domestic sales, much as you subtract expenses from gross receipts. By contrast, the credit method VAT looks like a sales tax. You charge tax on an ad valorem basis on your sales, and you get a credit for the tax that was charged on your purchases, and those credits are refundable, although we learned today that buys you a guaranteed audit if you attempt to claim the refund. Some countries, notably one that was represented earlier today, are very slow to pay those refunds. So setting aside the wage deduction feature, which could be implemented with a wage credit, if you have a consumption tax, whether it's the subtraction method or invoice credit method, and there is a single rate, and there is a comprehensive base, and there's similar levels of compliance, and the losses are fully refundable, then these two systems, are identical economically, with a slight difference that the subtraction method VAT is tax inclusive and the invoice credit method VAT is tax exclusive. Tax inclusive meaning the tax is imposed on top of the tax itself. So for example, the 20% destination-based cash flow tax is equivalent to a 25% VAT, again, leaving aside the wage deduction because of the tax on tax component. Like our income tax, you could think of as being a tax on tax. So there are a number of proposals that have looked at subtraction method VATs, although not with the wage deduction feature. You might recall that Speaker Ryan was once chairman of the Budget Committee, the House Budget Committee, and he put out something called the Roadmap for America's Future. That included a 7% business consumption tax, which was a 7% subtraction method VAT without the wage deduction. Also in the Republican primaries, one of the candidates, Ted Cruz, proposed a 16% business transfer tax, which also is a subtraction method VAT. So I'm going to talk about more or less the pure destination-based cash flow tax. The blueprint, as it's called, deviates in a number of important respects from the destination-based cash flow tax or a pure subtraction method VAT. Pass-through businesses are taxed at graduated rates. That's not a feature of a pure destination-based cash flow tax. Losses are not refundable in the blueprint. They carry forward with interest. In the VAT and principal, they are refundable. The blueprint does tax interest, dividends, capital gains at the individual and corporate level. That would not be part of a normal VAT. There's a research credit that would not be part of a VAT. Now, the other approach, the invoice credit method VAT, this is used in, according to the OECD, 167 countries now. In some countries, it's called goods and services tax. Others, value-added tax or equivalent. In the U.S., the proposal that is most like a proposal that Professor Michael Gratz has advocated is Senator Cardin's proposal. He calls it a progressive consumption tax, the Progressive Consumption Tax Act of 2014 specifically. And this is, like other countries, that in addition to the income tax system. The blueprint is intended to replace most of the income tax system except the taxation of investment income. But the Cardin plan, like in just about every country in the world that has a VAT, is in addition to their existing income tax system. It's a 10% credit method, destination-based VAT, and the money is used to reduce the income tax. It reduces the corporate rate to 17, gets rid of the corporate AMT, reduces the top individual rate to 28. It has a large family allowance. It takes probably 100 million returns out of the system. It deals with regressivity with expanded refundable child and wage credits. And it's intended to be revenue neutral, probably would need to be, the 10% VAT rate would probably need to be a little bit higher, maybe more like 13 or something to be revenue neutral. It's not the only VAT proposal. There is a Republican version. Jim Renacci on the Ways and Means Committee has a proposal called Simplifying America's Tax System, which is a 7% VAT that's used to replace the corporate income tax and reduce individual taxes by a more modest amount than the Cardin proposal. So there are live proposals. Of course, the blueprint has far more political traction at the moment than the VAT, which may not be saying a huge amount, but the VAT is very, very remote in terms of likelihood of enactment. So the consumption tax components of both of these, the blueprint's destination-based cash flow tax features and the Cardin bill's, credit invoice VAT, they're both consumption taxes, and they both have a lot of advantages over our current income tax system. These consumption components treat debt and equity the same. They both eliminate the ability to erode the tax base through transfer pricing, which we heard about on the first panel. Tax-motivated shifting of income to low-tax jurisdictions. These taxes are neutral as to the location and scale of investment. They're neutral to the form of business incorporation, at least the pure destination-based cash flow tax and VAT. They don't lock out foreign earnings as our current tax system does. They're actually neutral to inflation, which is something we don't worry about much now because inflation is relatively low. But there certainly was a time when we were very concerned about the distorting effects of inflation in our income tax system. That goes away in an expensing type world. And there are areas where consumption tax is simpler to administer. You do not have a need for cost recovery rules. You don't need to separate repairs from investments. You don't need expense allocation rules. You really don't need anti-base erosion rules. You don't need anti-inversion rules. You don't have to spend a lot of resources enforcing transfer pricing rules. So a lot of desirable things. Of course, even a pure consumption tax is not tax nirvana. There are issues that VAT countries face. Taxation of financial intermediation services has been challenging in every country that has a VAT system. The taxation of imports of electronically supplied services, directly by consumers. Whether that's electronic games, music, videos, you name it, software. That is quite challenging in any form of a destination-based tax system. And compensation is challenging, but in different ways. Under the blueprint, because of the wage deduction and the different tax rates on wage and business income, it'd be very important to separate wages from business income in closely held businesses. That is a very, very significant issue, by the way. The revenue costs of the blueprint lower rate on pass-through business income. They cap it at 25%. So they use the destination-based cash flow tax base that corporations use. They tax at graduated rates up to 25. But wages under the blueprint are taxed at 33 at top rate. And so there is a very, very big incentive to recharacterize your wages as business income in a closely held business. The revenue costs of that recharacterization are gigantic. And so huge amount of effort would need to go into developing rules to try to police those boundaries. Of course, we're not free from those issues in our system today. So as many of you know, there are incentives in S-corps to do a little bit of recharacterization as well. Under VAT, it's a different compensation issue. The issue is when you go and you buy property, say an automobile, is that a business expense, or did you buy that for personal use or for the personal use of your key executive? There are a lot of expenditures like that, and that is particularly challenging since you are entitled to get a VAT credit on a purchase of a car if it's for business use, but not if it's really disguised form of compensation. So employee compensation is an issue under both versions of this, the VAT. So now I wanted to turn to why it is that I prefer, from a tax administration perspective, the sort of destination-based VAT over the destination-based cash flow tax. So I would say the starting point would be just international experience. I mean, there are 167 countries, right, that have a VAT system. There are precisely 0 that have a destination-based cash flow tax. And, if you think about even just the lead time, right, to writing all the guidance for how this would work, it would take massively longer if you're starting from an untested tax system. I think it would also take quite a bit more effort for taxpayers to actually understand how the rules are supposed to work, because there's just really no other place to look. So that would be reason number 1. Reason number 2 would be the different impact of exemptions and reduced tax rates. So, in a tax system like our income tax system, as you know, we don't have a parliamentary system. We have a lot of opportunities to influence the tax process. Taxpayers are very well organized to do that. And the pure tax systems that we dream about, in our academic papers, tend to get rather less clean by the time they're enacted, and they get amended very, very frequently. And so you want to have a tax system that's fairly robust against frequent changes and distortions of the tax base. And the VAT, surprisingly, is more robust than you might think, which is that, if you are selling to other businesses, you do not want to be exempt. If you are exempt, it means your business customer does not get a credit. And, well, that's fine, you didn't charge tax, but you as a seller of an exempt good or service don't get a credit for the things that you bought that are attributable to your exempt sales. So you end up with blocked input VAT recovery. There is more tax from an exemption than would otherwise be the case if you're in the system. That's pretty powerful. That is not true in the destination-based cash flow tax. If you're exempt, your business customer gets a deduction. There is no invoice mechanism that controls that. So the incentives to lobby to get exemptions are rather large. Similar issues occur over reduced tax rates in business-to-business sales. Incentive to do that in a destination-based cash flow tax, to be taxed at 10 instead of 20, that would not happen under a VAT system. The next issue is net operating losses. Net operating losses, are problematic. Governments don't like to refund them, and that is reflected in the design of the destination-based cash flow tax, where they provide unlimited carry forward with interest, but only let you offset 90% of your tax in any given year with losses, certainly not refundable. The challenge with the destination-based cash flow tax is not only are exports exempt, and because it's a VAT, you get a full deduction for the costs related to your exports, but wages are deductible as well. That is not like the base of a VAT. There is no wage deduction of VAT. So the likelihood of an exporter moving into a negative position is much greater. And basically, if you exempt more than your operating margin, you will be in a negative position year after year after year. And your just losses will build up. So that is a very undesirable feature. Taxation of imported goods. I think many of you may have heard of carousel fraud. So certainly that is not free of fraud, but the fraud is biggest where a company can buy things without having to pay input VAT because they on-sell to their final customer who's an innocent victim, they collect the VAT, and then they disappear. Okay, so they've got the VAT on the sale, which they've pocketed, they don't send it to the government, and because they were able to buy their inputs without VAT, they're not losing any VAT credits. Okay, so this carousel fraud occurs when you have inter-EU sales because they don't charge VAT on business-to-business sales from one EU country to the other. So it's a business you can buy without incurring, this VAT that you'd want to, get a credit for. This is the model for the destination-based cash flow tax. It's basically importers importing, and basically there's no VAT collected at the border. So there's, the incentive to do this disappearing trader fraud, which is also, the carousel fraud system, is a big deal. Now, you can control it on goods if you collect tax at the border. That's not apparently the way the destination-based cash flow tax works. It's this, you don't get a deduction for imports. So it's not that there's a tax collected and you get an offsetting credit. It's just there's no border control at all. So the opportunities for carousel fraud are a lot bigger. Of course, with services, there are no border controls under either system. And one of the big areas of carousel fraud was actually trading emissions control allowances under the carbon trading system in the EU, basically an intangible. State taxation. 45 states in the district, they have income tax systems that piggyback on the federal income tax system. The destination-based cash flow tax eliminates basically an origin-based income tax system, goes to cash accounting and so on and so forth. Becomes a real problem then for the states. I think you basically have 45 states that now have to administer their own income tax system with increased costs to them and to the whole efficiency of the tax administration system, and also probably a lot more expense to multi-state taxpayers who will probably see much greater divergence between the tax bases in the different states. Transition issues, I must say that in VAT systems, when they raise the rate of VAT or they introduce a VAT, even if they couple it with a reduction in the corporate income tax rate, they don't have all these transition rules. But when you put in a destination-based cash flow tax and you repeal the income tax system, not just lower the rate, but you go to zero, every taxpayer that has basis, whether it's in inventory or depreciable assets or interest expense or whatever, they want their transition rules, and that's very expensive. It reduces the revenue that you can raise, and one of the insights from work that Alan Auerbach and others have done is a lot of the efficiency gain from switching from an income to a consumption tax is actually the tax on old capital. That is a big, a tax on old capital is efficient. It may not be fair in some sense, but very efficient because it doesn't affect behavior. If you give that all back through transition rules, you lose a lot of the efficiency. So accounting issues are another factor. We don't know how the destination-based cash flow tax will be accounted for. That is a little bit problematic. VATs are basically not reflected in income tax statements, so the tax that's charged is excluded from the accounts. Kind of like the way that retail sales taxes typically would show up. So they don't really have an effect on the reporting of financial profits. We don't know whether destination-based cash flow tax would be viewed as an income tax, and therefore we'd have these really big timing differences, for depreciation and so forth, going to a full cash method while financial accounting is an accrual method. And that's kind of problematic if, business decisions are, made on the basis of financial results. I mean, part of the gain, we think, economically from going, to an expensing, type system is that, this will promote increased investment behavior. If that doesn't show up because it's just a timing difference, you may have very different results, at least for public companies where they pay a lot of attention to the way that profits are reported. A lot of confusion, I think, for analysts, too, to figure out what, the... So I will come to my conclusion. I'm going to skip the international issues, the WTO and bilateral treaty issues. Needless to say, there will be trade and tax retaliation in a way that would not occur if we did the add-on VAT. So my conclusion is that tax proposals have similar economic properties, in theory, can have very different impacts in the real world, depending on how they're drafted and administered. The design of U.S. tax policy needs to take into account these reactions of foreign governments, which we didn't talk about much today. And as in the reform of governments, in the reform of taxes, sometimes revolutions create unanticipated problems. Thank you. And I'll take questions. you have any questions? I think we have 4 minutes. Yep.
Given that VATs exist in 160 odd countries, all the OECD countries, is there some simple explanation as to why it is considered such a complete non-starter, such that we would try some completely untried alternative plan in the Congress?
Yeah, so as a member of Congress, voting for a VAT is thought to be very bad for your job security. And, there's reason, to think that from some of the experiences in other countries. Brian Mulroney introduced their goods and services tax in Canada, and the next election, the Tories took the largest loss they ever had in history. I mean, they dropped from like a couple hundred to maybe 3 representatives in Parliament. In Japan, when they introduced theirs, Nobuo Takeshita went down in a very big defeat following introduction. American public just, does not like these visible taxes. I mean, it was driven home to me when we were looking at the Highway Trust Fund funding, and huge amount of effort went into finding funding for the Highway Trust Fund, and you might have thought that this was a very easy thing to do. I mean, we haven't increased the gasoline tax since 1993. It's still at 21 cents a gallon. It's gone down in real terms dramatically. And you would think that, with gas prices as low as they are now, it would be the easiest thing in the world to increase the gasoline tax by a few pennies to fund the Highway Trust Fund. But it's a very visible, unpopular tax. The OECD member countries, you have to have a VAT to be a member of the EU. Not the OECD, but the 28 EU member countries, you have to have it. If you go to the IMF for a structural assistance program, basically financial help, they very strongly recommend that you adopt a VAT as part of your financial restructuring. And if the IMF is lending you the money, you tend to pay attention to it. So in some sense, maybe VATs have been forced, on other countries in a way that would not occur in the United States. So long answer to, if you vote for a VAT, most members of Congress believe that they won't be reelected. Yeah.
Hello, Stephen Rohde, ASR Analytics. I really appreciated your talk. I think, touched on a lot of aspects of taxation and factors to consider. One other thing that was on my mind, and I was hoping maybe to get your thoughts on it. So much of tax administration is not legislation, but regulation, custom, tacit knowledge among practitioners. And I was wondering, thinking about those things, are either one of these taxes more easily implemented, or could either of them really be implemented at all?
Well, we know that VAT can be implemented because 167 examples, including in Canada with provinces that have harmonized. One of the questions for the U.S. is, can we do a VAT because we've got, so many states that have retail sales taxes. For a long time, we thought, oh no, you can't do that because of these state sales taxes, and they couldn't coexist. And what Canada found was, oh yeah, actually you can. They have their goods and services tax, and some provinces are part of the harmonized sales tax system, and some have kept their provincial sales tax, and you get a receipt, when you go to buy something that shows VAT or GST and PST, provincial sales tax. My concern would be the IMF recommends to countries that, when they adopt a VAT, that they allow about 2.5 years from the date of enactment to the date of actual implementation. And that's to give, time for all the guidance to be written, for taxpayers to update their systems and all that sort of thing. So that's in a case where you have 167 examples, a lot of best practices that you can follow. I mean, as my friend Ty Grinberg likes to say, just take the New Zealand GST statute and transfer it into your own legislation. This is a good place to start. With destination-based cash flow tax, you're not really starting with any existing statutory legislation. So I just think that trying to do that without a very significant amount of time, for the IRS to write the guidance, for taxpayers to understand it, develop their systems, is wholly unrealistic. You want to take? Should I take one more? Or were we done?
Very quick.
Okay, one quick question. No.
Yes, you've avoided using the words border adjustment tax. Is that, I'm just not familiar with the terminology. Is that the same thing as what you're talking about?
Yeah, the press has used border adjustment tax as the acronym for the blueprint, highlighting probably the most salient feature of it, which is the border tax adjustment. So in my world, I'm used to seeing BTA, border tax adjustment, as the acronym, but that's what's being used to refer to the blueprint. Okay, well, thank you very much.